Perfect. All right, guys, I'll make it just about 4:30. So let's jump into it and get kicking straight off. So sounds like everything's okay. If there's any problems as we go through, just use the chat function just to let me know if there's any problems with the sound quality or the picture or the slides or anything else. Otherwise, we'll just push on. I'm assuming that everything's okay. It wouldn't be the first time I've been sat here talking to myself, but I had a few comments back already, so hopefully all is good. So welcome along today, and as I said, down the bottom there, you're going to find that chat function. Any questions that you have as we go through, do feel free just to type in there. And as we get towards the end, I'm going to make some time to get to as many, if not all the questions if we can. I'm probably going to run for about 30 or 40 minutes, and then we'll get to all the questions at the end. So I do tend to go through these presentations fairly quickly. I want to try and give you as much information, as much value as I can. And sometimes that can be a bit overwhelming. So if anything, I'm going through something you're not sure about what it is, just feel free, type it in the chat function down the bottom there. And as I said, we'll get to it as we go through towards the end. So let's just make sure you're in the right place for this workshop. So this workshop today, all about how to value your cafe, really going to suit anyone that's considering the sale of their business at this point. It's also going to work well for anyone who's currently on the market. Maybe you've been listed for a while, you're not getting the traction, you're not getting the results that you wanted. Or maybe you're just somebody who wants to understand the way that cafes are valued. And really what I want to try and do today is go through that from the broker's side, so you get a kind of behind the curtain look at how, certainly how we do it, and the method that we use, although broadly speaking is the same as most, the detail that we put in is quite different to a lot of other people. So I'm going to give you some insight into how we do it and how you, for your own purpose as well, can get an idea of what your business might be worth. So the main goals from this workshop today, really, there's three things I really want you to take away from this. So firstly, obviously looking for you to get a really good, clear understanding about how cafes are valued. Also going to look at the things that affect the value of the business and what you can do to influence the increase in the value of your business. And then make sure, as I mentioned at the end, or as we go through, that any questions you've got specific to your situation or just generally speaking about this topic, we want to make sure you go away with all of those questions answered. So that's what we're hoping to achieve. And if we both walk away with those three things ticked, then hopefully it's been a good use of time for all of us today. So don't hold back. If you've got questions that you want answered, do just put them in the chat section. And if not, if there's things that you'd like to discuss that you feel are confidential, then I'll give you a link at the end where you can submit those questions as well. So just for those of you that don't know me, I'm Paul Leach from GSE. I've got 25 plus years of hands-on experience in the industry. So over that time, I built up and sold 9 of my own food businesses. That ranged from all sorts of things, from pie shops, cake shops, we had bakeries, sandwich bars, restaurant, cafe, all sorts of things. So we've, my wife and I worked together for all of that time. And had a lot of hands-on experience, and then yeah, like most people, just got to the point where it was all a bit too much and time to do something else. So that actually is the picture here of the first shop that we had. That's me at the back there before the industry got hold of me and changed the hair color from dark to grey. So that's me, and at the back there's my 2 managers. Now these 2 guys worked for me. I had this shop for 11 years, and these boys worked for me from day one right through to the day we sold it, and we actually sold it to them. So this was my first experience of vendor finance. So we worked a deal out to help the boys to get a head start that they would never have got. We ended up getting a much better price for the business than we would have done on the open market. We also, because we vendor financed it, we also made money on the sale through interest on the loan that we arranged for them. So this vendor finance, actually, we've done a few deals recently with this. It's becoming more and more popular now as the lending criteria tightens up. But this was just something that we didn't do for any other reason than really just to help the boys out. So we had the business for 11 years, and they then ran it for a further 14 years, the 2 of them very successfully. So that was, yeah, back in the day. This was about 92 we opened this one, and this picture was taken in the year 2000. So yeah, 20 years ago now. So definitely there's probably a few more years there than I originally thought might need Might need to update that slide. It's been longer than I remember. But yeah, very good experience with that business. And as I said, that sale process was kind of started my interest in it. So as I went through and sold other businesses, as you probably appreciate, had made a lot of mistakes. And whilst the sales process of a cafe or a restaurant is not rocket science, there are a lot of things that you can get wrong. And I think probably throughout the process of selling on my own and through brokers, I did make most of those mistakes. The good thing for me is that with that, I did learn some valuable lessons. And whenever I do that, I've got a bit of kind of OCD with that sort of thing. And so I documented all the good and all the bad about both ways. So selling on my own and selling through brokers, what I liked, what I didn't like, what I worked, and kind of refined the system. So when I got to the point I mentioned previously, where I was just over it with, the physical side of the industry and the staff side and everything else, I decided I really wanted to stay in the industry because I do love the food business. I love the hospitality game. And what I'm doing now allows me to stay in touch with that. So when we sold the business, the last business, we started GSE, and now really just calling on the experience that I had from all of my operational time and buying and selling, of course, coupled with selling businesses for other people now to run GSE that specialise basically in exit planning. So whilst we're licensed as brokers, the core of the business is around the strategy and the planning for the exit. And then we took on the brokerage. We never used to do that when we first started. We took on the brokerage because whilst we were successful in preparing people for sale and getting them ready, we couldn't find somebody that was continuing the level of service we provided on the brokerage side. So just to get around that, we became licensed, and we're currently licensed in New South Wales, Queensland and ACT. So hopefully that gives you a little bit of context into how I'm kind of, I guess, qualified to a degree to talk about what we're looking at today. We work with a lot of business owners around valuation and appraisal. And so really that's the core of what we're talking about today. So let's, without further ado, jump straight in and talk about the appraisal process. So the appraisal basically is a term that we use, and what that means is it's a method that we use or people use to work out the current value, the current market value of your business. So it's called an appraisal because we can't use the term valuation. In order to do that, you need to be a registered valuer. So what we do is we'll appraise a business, and we'll show you what an appraisal looks like. So a full appraisal, there's several reasons why that's useful to have. The three main ones that for my money, for the way that I look at it, is firstly, you really want to understand the value of your investment. Now, most people that we talk to have invested a significant amount of money into their business. In most cases, it's tens of thousands, and in fact, more than that, probably it's hundreds of thousands of dollars. So your business is a big chunk of financial investment. And of course, I'm sure I don't need to tell you, it takes a lot of blood, sweat and tears and a lot of your time. So you've got significant investment in that business, and you want to make sure that you understand what the current value is and what the value is when you come to sell, because going to market, when you go to market at the right price, gives you a much better chance of getting the business sold in a reasonable time frame. So one of the biggest concerns that people have that we talk to is around confidentiality and not wanting staff, suppliers and other people to find out about the sale. And one of the best ways you can do that and keep it as confidential as possible is to make sure the business isn't on the market too long. So coming to market at the right price is crucial. So again, really a good reason to go through the appraisal process and understand, where the value of the business is currently at. And that leads on to the third point, which is knowing what the current value is a great starting point for your exit strategy and your exit plan. So with most people that we talk to, there's not been much planning or preparation put into the sale process. And what we're trying to do is to try and encourage people like yourself to really look at it and think, okay, well, before we go to market, let's make sure we're fully prepared, make sure that when we do sell, we're actually going to come out with an amount that works for us. We're not going to go to market, get stuck there for a while, and then finally we've got to keep dropping the price and lowering the expectation in order to attract a buyer. So the way that we work is that, you take that appraisal for now, you work out how does that sit compared with what you'd like to sell the business for. If there's a difference, what can you do? What can you tune up? What can you improve to make sure that you are getting close to what you want, if not what you want or more, and that's going to be meeting the expectation of the market. So knowing where you're at currently is a really good starting point. And as I said, with the exit plan, once you know that figure, you're going to have an idea of what you need to do, whatever it is you're looking to do, whether that's to retire or whether you're going to buy something else. So it's crucial and really important that you understand where the current value sits. So the appraising of the business and the way that the value of businesses is worked out, it varies from industry to industry. And if you go online and search, there's lots of different theories and lots of different ways that businesses can be valued. Typically with sort of businesses in the hospitality sector, especially those sort of below $500,000 or below 600,000-700,000, the method that's used to work out the value of the business is what's called the multiple method. Now, what this means basically is that we're going to take the net profit that we can demonstrate for the business. That's the annual net profit. So how much has the business made after all the expenses and everything else at the end of the year, before depreciation, amortization, and any tax, with the exception of GST. That figure is then multiplied by anywhere from 1 to 3 times that net profit. And that kind of scale, there's several factors that will affect where you sit, and we'll look at those in just a moment. But what that, in rough numbers means, if you're showing a profit of 100,000, then in layman's terms, it's going to be worth somewhere between 100 and 300,000. That's the very broad way of looking at it. From there, you're going to come down and narrow down based on the things we're going to look at on the next screen, about where you might sit in relation to that. So the multiple method, very, very straightforward way of working things out. And as I said, most common in the hospitality game for cafes, restaurants, takeaways, and so on, to be valued based on that profit. So there are some key things that we'll look at, and we'll go into more detail about how to work out what that profit is, because it's not necessarily just a case of running the P&Ls and working it out from there. There's several things that we need to look at, and as we go through today, we'll go into a bit more detail about how to actually do that. So with the with the 1 to 3 times net profit that I mentioned, we're just going to look now at some of the things that will affect where you sit. Are you going to be closer to the 1 or closer to the 3? And it really will depend on these things. These points are not in any particular order, but as we go through them, I'm going to give you an idea of the ones that I feel make the most difference. So the first one, as you can see there, is the income that's produced for you, for the owner, versus the input that you have to put in. So what that means is we're going to look at what, if I was to buy your business from you and continue running it based, in most cases, as a full-time working owner-operator, then what can I expect to earn? What am I going to get back? So that profit plus anything you earn is classed as your income as the owner. And the input side of things, what that means basically is that might differentiate, for example, between, let's say, a business where the owner's working, 7 days a week versus a 5-day cafe, or even a 7-day business where the owner's only working 5 days. So that will play a part in the scale of things, where you're going to sit on that scale. So that input that you've got and the income that you get is an important part of it, and definitely a figure that will be instrumental in working out where the value sits. Next is how well established the business is. So if the business has been there for a long time, if it's been there for sort of 20, 30, 40 years, and I've had businesses like this. I had a business that had been, before I bought it, had been there sort of 55 years. So you kind of know with a business like that, that unless you go in there and completely stuff things up, it's a slightly safer bet. And that's, again, this kind of reducing the risk in the buyer's mind if it's a really well-established business. And we'll use this quite aggressively in the sales piece if we've got a business that's been there for a long time. You know, if you get objections from people about a business that's well established, then it's quite easy to put it back on them and kind of turn it around to kind of overcome that objection and say, you know, things like, well, if it's been there sort of 25, 30 years, then it's still trading well. It's a good sign that with the right operator, there's no reason why it shouldn't continue to do so. So how well established the business is pretty important. And how long you've operated the business is also a factor that's looked at. Again, coming back to something that I'll talk about quite a lot, which is risk. And if you've only been there for a short period of time and the business is on the market, naturally buyers are going to be suspicious or cautious or wary and worried about why you're selling the business so quickly. So, you know, it's important. It doesn't mean that you're not going to sell it if you've only been there a short time. But if you've been there for a long time and you've been taking money from it and it's been providing your family with an income for a good number of years, then it definitely helps you. And that's, I guess, whilst it's not something that's going to prevent a sale or put people off, it is something that on the positive side, if you've been there for a long time, it definitely works in your favor. And it's definitely something that can push that multiple a little bit higher for you. Next is probably one of the most important things, and that's the lease. Anyone that's seen any of my stuff will know that leases are something that I really do go on about quite a lot. And there's a reason for that. And that is that the lease and the strength of the lease is something that can make or break the deal, really. If you've got a good lease with a good term and everything's where it should be, then you stand a much better chance of getting a higher price. And again, much better chance of getting the deal through. So the lease is something that we would suggest you look at early on and make sure that, you know, if you haven't looked at it for a while, that you're going through it and double checking everything. So if this was in a, you know, a list of the most important first, this would definitely be up the top, very, very near the top for me, this one. Next, the location. Location is a very subjective thing with buyers. So there's not many people that we talk to that, you know, when you're asking them what they're looking for, they'll typically say, I want something in a good location. And then it kind of leads on to say, well, you know, you tell me what your idea of a good location is. And that varies so much. You know, some people, a good location for them is being in a Westfield. For others, that's just like their worst nightmare. So the location is subjective, but it's also important. If you've got, again, a place in a really good location without too much competition, or a, you know, waterfront or that kind of thing, again, that does make a difference on both sides, positive and negative, in order for pushing the multiple up or sometimes dragging it down. You know, if you're in a position where there's an awful lot of competition, even if you're performing well, then sometimes buyers, you know, they do get put off by too many places in one area. So location is an important factor. It's not crucial. It's you know, if we were looking in order of importance, this would be probably fairly close to the bottom, but it is a consideration for a lot of buyers. The future growth potential of the business is something that whilst it's something that when we're talking to people about their business, you know, the word potential gets thrown around a lot, and potential is something which can really help you with the sale and can help you with the sales process, but it's not something that massively increases the value of the business. So whilst you've got, you know, control as you go through the sale process, if there are things that you've got potentially, like, you know, if there's an opportunity to bring in catering, you're far better off actually bringing in a few catering clients and proving to people that there is a demand there and it's already started, than telling them there's just the potential of doing that there. So people want to see the growth potential, but they're not going to pay for it, if that makes sense. So you need to demonstrate that is there for them. Like most people, and people will, that, you know, buyers sometimes will be put off if they don't see potential for growth. So you want to get a balance between highlighting the fact that there is potential there, balanced with actually demonstrating that there is, you know, there's already some steps in place to execute on that potential. The level of the fit out, the decor and the equipment is something which it does play a part in helping you to convert people quicker. It definitely, if you've got a place that looks good, presents well, you stand a much better chance of getting people to take action quicker and becoming more engaged than you would if the place is run down, needs painting. And, you know, what happens if people come in for an inspection, or they come in as a customer to have a look at the place, if there's things that they can see need doing, they immediately start thinking, well, okay, I need to do that, I need to do that. The risk thing increases, and also they then try, you're basically giving them an opportunity to have an angle to try and reduce the price. Even if you've priced the business based on certain things needing to be done, you'll find that people will try and push it down on that basis. So whilst it's, you can't look at what the profit is of the business, multiply that by 1 to 3, and then add the value of the equipment on. If it presents well, if it looks like it's been well maintained, if you can say to, prove to people it's, you've got service records and it all looks good, then although that's not necessarily making a huge difference to the asking price, you're going to find that that will increase it slightly, and it will help you to get the sale through and help you to get it done quicker. So try and take an objective view of your business through a buyer's eyes. And it's very difficult when you're in there every day, you kind of, you go blind to certain things that other people might see the first time they walk in. So it's always a good idea to get other people to have a look and give you some constructive feedback, and then make any changes. I went to a place the other week that they had a big hole in the floor. It was like it should have been a sealed floor. Now that's I'm sure not compliant from a health point of view, and that had been something that they basically just put a mat over and covered it up. But it's something that buyers will pick up on straight away, and they're going to want that done. So think of it a bit like presenting your house for an open inspection. You want to make sure it presents really well. And as I said, get some constructive feedback from people that you trust about things that you might have gone slightly blind to. So the current market is, again, one of those things that would be up the top of the list along with the lease. The current market is going to influence what you can ask for significantly. So finding out where the current market is in relation to, what things are selling for of a similar nature to your business on a multiple wise is extremely important. It's a good idea not to rely on what you see things advertised for, because typically there's a lot of businesses advertised for sale based off what people want to sell them for, and based on the brokerage side, based on what the vendors have told the broker they want to sell for. There's not that many businesses priced correctly, but you have to be aware that the market is much savvier than it was even 3, 4, 5 years ago. The access to information now, obviously with Google and the internet, it's phenomenal. And people know, with online forums and even groups like ours, they'll know where the current market sits. So if you're overpriced, the market's going to know fairly quickly. So you need to find out where that's at. And there's, the easiest way to do that is to look at what things have actually sold for that might be in a similar location to you, of a similar size and a similar kind of turnover and profit. But typically you can find out through the multiple, and that's something that, look, we don't make any big song and dance or secret about that. If you want to message me or you want to get in touch anytime about where the current market sits, I'm more than happy to disclose that if we've had business sales in your area. So find out, if you can, where the current market sits, what the multiple is for businesses like yours, where they're selling. Just roughly at the moment, the current market, you're probably looking anywhere from 1.5 to 2 times net profit. We've got a couple going through just over 2, but certainly at this stage, there's nothing close to 3. So it really does depend on where you're at location wise. CBD locations, for example, at the moment, very, very difficult in most cities. Whereas suburban cafes, we're seeing businesses sell over asking price. The last one in West Sydney that we sold that was about 25,000 over the asking price. So it just depends. The current market with COVID and the whole situation is completely new territory. So the best you can, try and find out what that is. And as I said, if you want to pick up a call at any time or reach out, I'm happy if I can to help you with that, where that might be sitting. And the last thing there, just again, this probably is fairly well placed towards the bottom of the list, but trading days and hours. So typically, if you've got a 5-day business, then you're going to be higher on that multiple than a 7-day. 5-day businesses are much more attractive. There's a couple of reasons for that. Obviously, it balances lifestyle and work, and it gives people that growth potential that we spoke about just before, to look at it and say, well, you know, if we wanted to, maybe we could open on a Saturday morning, and already we're going to be taking, you know, a couple of $1,000s more. So trading days and hours is something that is important. And you know, if you've got a 7-day business, sometimes it can work to your advantage to actually look at the hours, and even with a 6-day, look at the hours, and can you reduce those hours at all, which is going to make it more profitable, because obviously the labor costs are going to come down. If you can trim that down and actually make it look more attractive, you know, quite often a lot of people we work with have done this. They've actually ended up working less, making more, and the business is worth more as well. So do bear in mind that trading days and hours will make a difference to where you can sit on that multiple. So those are they're the key points. There's a few other bits and pieces, but those are the main ones to consider, or that can influence the value of the business. And you know, some of those you've got control over, and there's probably, I guess, the overriding thing that I guess I always try and communicate to people is that the exit planning process and the sale process, what you want to be thinking about is reducing the risk in the mind of the buyer. So typically, the higher the risk, the lower the price, and it works the other way around. So the more you can present the business as a low risk opportunity for a buyer, the higher you can typically expect to ask the price. And that is also going to make it more attractive. You're going to get more traction, and you're going to get buyers moving through the process quicker. So just try and step back, look at it through buyer's eyes, and anything there that you see as a risk, and that might be something like a, you know, a very short-term lease, for example, is going to worry people that they might invest money in buying the business from you, and then in 2 or 3 years' time, they're not going to get another lease. So anything you can look at as a potential risk, and as I said, try and look at that objectively. Then look at it and try and find a solution before you go to market. All of these things are better dealt with before you list, rather than getting on the market and then finding there's a problem, for example, with a lease that then stalls everything. Because once you get the sale moving, once you get somebody interested, it's crucial to keep the momentum up, because otherwise it can stall, it can go backwards, and also it can fall over as well. And it's not, even after exchange of contracts, it's not guaranteed that it will go through. So the more you can do at the front end, the better. And this is an analogy that I always throw around, like, you know, with the sale process, you want to have it organized like you would with preparation for lunch service. So you want to be going in fully prepped, everything done, all your mise en place in place and ready to go. And then you know that if you're busy and you're fully staffed, you're fully stocked, and you've got all your prep done, it's going to be a smooth service. It's going to be good for business, good for the customers and everyone involved. It's very, very similar with the sale process. It's all about the preparation. So look at reducing the risk the best way you can, and that should stand you in good stead to make sure you come on fully prepared and at the right price. So the 3 key steps you can take when it comes to, I guess, kicking this off is, firstly, as I've touched on a few times already, study the lease in detail. Most people, and I'm guilty of this as well, haven't looked at the lease since the last renewal, or there was something came from the solicitor, or even since the business was purchased. So do make sure you go through that. Don't trust relying on other people just to read that for you. It's as dull as it is, and a lot of them are, you know, worded in typical solicitor speak. Do go through it and get your head around the key points. So you want to be looking for a demolition clause. That's pretty crucial. Make sure you read through the assignment clause, which is something that's is going to be instrumental when you get to the point of trying to come off the lease and put the buyer on. And make sure that there's nothing in there that, again, could be perceived as a risk by the buyer. So familiarize yourself with that. You want to understand what the increases are. Is there a market review? All those kind of things. They're going to be used in the marketing, but you're going to get questioned on that sort of thing as well, either by buyers or by the broker when you list the business. So make sure you understand the lease, and if there's things in there that need changing, you can get onto it nice and early. The financials, naturally, as we said, are going to be used in detail, and we'll look at that in just a second. But the financials are a very important part of naturally working out what the profitability of the business is, and from there, obviously, we've got that figure that we're going to use to multiply to see where the value of the business might be. So make sure that everything's up to date, and that you've gone through those as you did with the lease in detail, and that you can answer questions, and that you know your business as you should do, and probably do anyway, inside out. But this, we're looking at the last year's figures, the last quarter's figures, and so on. And as you go through the sale process, make sure that you stay on top of that and that you're up to date with current figures, so current margins and percentages, and that you've got current information put to one side for when people ask. So naturally, everyone's going to want historical information, but they will also want the current stuff. So, you know, sometimes people, it might be 2 or 3 months from doing this before they list the business, and that's a whole nother quarter. So as you do that, make sure that you're keeping all of the figures updated, and that everything's where it should be. And finally, you're going to look at the true profit of the business. So the true profit is what's coming out after things that you've taken that may be not necessarily payroll. They might be other things, and they're typically called add backs. So add backs are things that you've taken out of the business. Might be motor expenses, mobile phones, usually quite a common one. There could be food that you've taken for home and things like that. So on the P&L, we're going to work out what those add backs are and then add them to the net profit. So in this example, you can see there's a P&L there for a certain period of time. And then in these columns, it's just an export from, this is an export from zero, and then added a couple of columns here to identify and flag all of the things in this P&L that are add backs to the owner. So effectively income that's been taken in a slightly different way by the owner. So these things, if I was to buy the business, for example, these costs would not be incurred by me unless I decided to do that. So for the purpose of the appraisal, we can actually use those as add backs and total them all up at the bottom with the profit to give us the true profit figure. So this, in this particular example, you can see the difference that makes at the bottom there. So it's really important that you go through and you do identify everything. And as you do this, make sure that you're documenting it in a way that you can present this to buyers when they question it, as they will do. And you just basically outline everything, what they are. So, you know, loan interest, for example, complete add back, depreciation, motor costs, all of those sort of things. But make sure that you're able to demonstrate clearly and concisely to people how you've come up with the actual profit of the business is. And when you do that proactively at the start, people get to know that you really know what you're talking about, and they're more trusting of information that you give them from there on in as well. So getting off on the right foot is crucial that you do this accurately. Firstly, for your own purpose, so that you've got that figure worked out correctly. And secondly, so that you've got it to back up conversations that you're having with buyers about the profitability and of course, from there, the value of the business. So the other thing to consider is if there is a cash element to the business, and this is something that comes up all the time. Naturally, you know, the industry is full of cash, a lot less now than it ever has been. And I think with, you know, the contactless payments going up, and generally even pre-COVID, FPOS transactions going up from a complete flip from, you know, the pictures we looked at of my first business, that, you know, there was probably, I don't know, 90–95% cash at that time. You know, to pay by credit card, you had to fill out a triplicate form and put it on machine, and it was a whenever anyone pulled a credit card out, it's almost like a groan from the people on the till, because it was a process. But that, you know, as you know, is now completely the other way around. So we're seeing much higher merchant fees in P&Ls, and much higher percentages of income which we can track and trace. So in a lot of respects, the cash side of things has got easier. My advice would be, as you go into the sale process, then minimize this. In ideal world, you get rid of it completely and have, you know, a couple of BASs that actually, as a minimum, back up everything that the POS says and back up everything that the P&L say, you know, so your figures are clean. The cleaner the figures, the lower the risk, the higher the price. It's simple stuff. I know it's not, you know, for some people it's not practical, they can't do it or don't want to do it. So if that is the case, then you do need to demonstrate where the cash is and how the cash is coming in. And what we're looking at here is just a simple spreadsheet that you can produce. Those of you that are on, Margaret, I saw you're on, so those of you that are in the 6 Steps program already, you'll find the appraisal calculator in there. But you could just run a simple spreadsheet like this where you're entering all of the figures. Now, the figures in here are accurate. So any cash that's coming out, so from the turnover that's shown there, for example, that the cash that's coming out is included. And you'll note that with that, when we do that, we'll actually take the GST off as well, because if you're taking that cash out, that's your, it's your choice to run the business that way, and that's fine. It's completely up to you. But strictly speaking, to work out the true profit of the business, that GST should be taken off. So what we're doing here is giving an accurate representation of everything in, everything out, and from there working out again that true profit figure. So you'll notice here there's not as many lines as there are on the P&L, and that's because some of those add backs on the P&L don't need to be entered here because they're not relevant costs. So going through this process by doing this way, and we will typically do it this way as well as the add backs and the schedule from the P&L. The figure at the end of the calculations on both methods will, if you've done it correctly, will come out the same way. You're just using two different systems to demonstrate the profit to buyers. But this process here, making sure for your own purpose that you've got an accurate figure on both ways you've calculated it, is going to guarantee that you are positioning it at the right price. In this particular example here then, so, oh, sorry, jumping ahead. In this particular example, you can see that down here, we've got the annualized profit, which is then multiplied by a number over here. So these here have just been changed. So where this business is located, these are the multiples, roughly the range of multiples of recent sales for similar businesses in a similar area. And then that here translates into what the asking price and what the range might be. And we would then work out, based on some of those points we looked at previously, some of those 10 points we looked at, we'd work out where the business is going to sit, and we'd speak to the vendor about where they felt they'd want to list it. If it was a figure, if they wanted a figure higher than this, then typically we would look at how we can improve that. So, by this stage, we've looked at all the rosters and we know the business fairly well. So we're going to work out, is there a way we can reduce the wages? Is the food cost slightly high? And that can make a massive difference. So as you go through this, you want to be very aware of those percentages and just play around with that end of profit figure. If you can bring the wage cost, or if you can bring the food cost just even 1 or 2% down, you'll see this figure, it increases significantly. So that's how we would calculate it in the two standard methods that we'd use. And then again, as I said, this gives you a range. This is a fairly wide range, but we're going to know fairly instinctively where it should be positioned. And if you don't, even in the worst case scenario, if you go on and you know that you're right, even at the top end, if you go onto the market at this level and you don't get much traction in the first sort of 4 to 6 weeks, that's the market sending a very clear message. So we're finding that even in the current market, that if you've got it priced right, the ideal situation is you get more than one person interested early on. So ideally, you don't want it sitting there not getting any traction at all. And if that is happening, it's usually just down to the price. There can be other things, but normally it's the price. If you've got it positioned right, you can get 2 or 3 very serious inquiries interested early on. And from that stage, you stand a much better chance of selling. We're selling a lot of businesses at full or full asking price or over asking price, purely working on that basis of getting inquiries as opposed to just testing the market, which is a flawed process and doesn't really work that well. So I appreciate there's an awful lot of information there in a fairly short time, but as I said, I wanted to try and get through as much as we possibly could in this. So if you have any questions, please feel free just to type those in the chat section now, and if I can, I'll get to those right now. Failing that, if you'd like to pick up a call one-on-one, if you feel that you'd rather discuss this in a confidential and private manner, then I'm more than happy. You can book a call by visiting this page here on the main website. So it's on the GSE website. In fact, I'll just drop it into the chat now, and then if anyone wants to do that right now, you can do. So that's in the chat. But basically what that is going to allow you to do, it's going to take you to a page that tells you about our 6 Steps to Sale program. If you're not on that, this basically is where we work with business owners and help them to fully plan and prepare their sale. And then if they want help with the execution of the sale, we can do that as well. So under services, just go to 6 steps to sale and you'll find a page that looks like this. And this big orange button here and one at the bottom as well is going to allow you to book in a time to have a one-on-one chat. And we can go through in a bit more detail about your business and your personal situation and see whether there's anything that we can do to help you to work out what that appraisal figure might be. And, you know, if you want further information or you've got other questions, feel free to let me know on that call as well. So perfect. So that's pretty much it from me, guys. As I said, I hope that in return for your time, you've got some value. And if you've got questions, I will be more than happy to stay online for as long as you like. So feel free, put them in the chat, and if I can, I'll come back and answer those for you now. Otherwise, you know, look out for future workshops. We're going to be doing a couple more about how you can increase the value and show you literally the difference that a 2 or 3% drop in wages and so on can make. So look out for those, and thank you for your time today. And if you've got no other questions, I look forward to speaking to you soon. Okay, so perfect. All right, Alison, so good to hear from you, and a great question. So Alison's saying, I own my building, I don't have a lease, is it more or less desirable? So it's with owning your own building, Alison, then basically what you need to do is you need to work out what your plans are. Are you looking to sell the business with the freehold, or is it better for you to actually sell the business, retain the freehold, and then with a good tenant and a good lease in place, does that increase the value of your freehold investment and then go to market? That typically can work well. It's really good. I have to say, a short answer to your question, it is more desirable. So there are a lot of people that are interested in buying the freehold as well. So having the opportunity to, for a buyer, for example, to either buy the business on its own or to buy the freehold as well is a great option. But it's really good in the early stages. Talk to your solicitor and work out, if you haven't done it already, what kind of lease terms you're looking to offer, and work out, what impact with your accountant is that likely, and probably a commercial agent as well. What would they suggest you do in relation to lease terms? Typically buyers want a good lease term, like a 5x5. And I would imagine in most cases, if you get a tenant in on a good lease, then it's going to help you to increase the value of your investment as well. So maybe take some advice from a commercial agent if you haven't already about the property, and see what kind of difference that makes. Okay, so Alison's saying, yeah, didn't consider selling the business without the building. Yeah, look, it's I actually think, there's potentially value there, Alison, to do it in 2 stages. I would probably keep the freehold up your sleeve for the time being, and then if you get somebody that comes along that not necessarily advertise it, but if somebody comes along and proactively sort of suggests they'd be interested, then you can start that conversation. But in the background, make sure you've worked out all of your numbers and all of your lease terms and everything else. A good idea to have that in place. But yeah, look, I think I have got a couple of people with a similar situation to yours at the moment, and in both of those instances to date, it has been better for them to sell the business, keep the freehold, and then you can always offer the freehold to the owner before it goes to the open market afterwards. But I think you'll find it will probably increase the value. So yeah, good luck with that. That's a great position to be in. And as I said, short answer, yes, it is more desirable. So keep me posted with how you go. And I'm interested to find out in your situation what the what the outcome is. Perfect. So a question from Ian. So in the current environment, COVID and post-COVID, will country-based businesses be more attractive? So yes, Ian, it comes back to what we touched on briefly about location. And at the moment, the CBD locations that we're working with, it's very, very tough. Generally speaking, suburban cafes are, more attractive because they've proved that they're COVID resilient, and they're typically performing better at the moment. So it's going to depend, I guess, on how your particular business is performing. Are your sales up, down, or flat at the moment? Where are you at currently with sales? And how far out are you from, are you regional, or are you just a little way out? Where are you based? I'll just hang on, let you type that in. It's just going back to Ian's point there about the COVID figures. At the moment, it's very, I guess it's very difficult to try and get buyers to take action when the sales are down. So the COVID figures at the moment, like we've got several CBD businesses that have gone from taking, tens of thousands a week down to almost next to nothing in some cases. So we're still getting interest in those businesses, but what you're finding is that people are sitting in the background now, just waiting to see, when the figures come back to some sort of normality. So it's not that you're not going to get interest if you are down on sales, but those people are less likely to take action at the moment. And of course, there's a lot of bargain hunters around at the moment, which, to be honest, it's the same in any market. You always get that, but good businesses that are performing well, we're getting more buyer inquiries at the moment than we have for a long time, because, the upside, I guess, if there is one, is that there's more buyers in the market now than there were before. There's a lot of people that have been inspired to take action and buy a cafe they've always thought about doing because their work situations change. So that's driving the market, and there's less businesses coming to the market. So the whole supply and demand thing is at play at the moment as well. So it's going to depend. It's difficult to give a specific answer here, and I know it's a fairly broad answer, but without knowing complete context about your situation, it is difficult. And as I said, more than happy if you want to book in a time to have a chat about that. More than happy to. So I just saw your reply there, Ian. So averaging 30% up year on year, and you're regional. So yeah, like you're in a strong position, and the businesses we've got in a similar situation to yours are the ones I mentioned before in the sort of suburban nature that have proved resilience throughout, one of the worst pandemics that we've certainly seen in our lifetime, and hopefully ever will. So having that sort of almost like badge of honor to have done that, and proving and winning new business as well, that's the key thing as well. I think a lot of workplaces, a lot of people are not going to go back to how they were before, and whilst it might drop back a little bit, you can really jump on this at the moment to push the fact that you've survived COVID. Not only survived it, but you've actually built the business through that period as well. So yeah, very, great to hear that you're up like that. That's a really good result, and yeah, very well placed to leverage that. I guess with the way that we're working with that is, if we've got a situation like yours, we're really leveraging the fact that, as I said, you've survived. You're performing well. It's a strong business. It's resilient to almost anything. It's a great opportunity, and it's built up over the last year. On the other side, we're kind of playing it down a little bit and just kind of keeping people interested to the point that when the business gets back to normal, then it's going to come back. We're not taking, we're not accepting a discount because business has been affected by COVID, because although it's going to take a while to get back to any sort of normality in a lot of places, it will come back. But on the other side, on your side, if you like, then we are leveraging that and making sure that we're getting full value for businesses that are performing really well on the back of COVID. So I hope that answers. As I said, if you need any of you need any more information about that, then do feel free just to book in a time to have a chat, and I'm more than happy to go through in a one-on-one environment in a bit more detail. So perfect. Okay, guys. Well, there's no other questions that I can see there. So as I said, I hope you've got some value from today. And again, if there's anything I can help you with in the future, just feel free to reach out, and I look forward to talking to you soon.